Alright guys, so in this educational module, we're going to be talking about ICT ranges and price points and how to apply this in the market. If you would like this PDF, comment PDF below. Now what I've created is a free Discord, so if you want access to these PDFs, I'll put the link of that Discord in the description below, and then from there you can access that will be posted there. This is going to be a part of a 10 module series. A 10 module series I'm going to title Free ICT Mentorship. It's going to be 10 modules of education that I believe are important aspects that you need to learn, all for free, right? All on YouTube, all in the Discord. But again, this PDF will be in that Discord. So if you want that PDF, comment PDF below. But without further ado, let's get straight into the video. Ranges and zones. Ranges and zones. What's a range? What's a zone? How do I use the ranges? How do I use the zones? And how can you maybe use this to, simplify your trading? Let me just say this. Every single day that I trade, I love to use the Asian range as a zone, right? So me personally, I'm a London session trader. You can do the same thing if you're a New York session trader. Use the London range as a zone. Important. I think it's really important because ranges are just applicable to so many things, right? You can use key sessions like Asian session, or you can also focus on dealing ranges. So today that's what we're going to talk about. We're going to explore ranges in terms of key sessions with a focus on the London session and on dealing ranges too. So we'll keep that in mind. Keeping things nice and simple, again, it's the best way to do it. Too many people complicate things. All we've got here at the top, we've got Asian buy side, that's 7 o'clock roughly over here, and then Asian sell side. So I've marked out the extreme high and the extreme low of that Asian range, right? For me, it's 7 to 12. For some people, it's 8 to 12, 6 to 12. This is just what I personally use and what's worked for me. So that's what I'm going to go through here. So keeping things nice and simple, 7 to 12. Again, we've marked out the high point, we've marked out the low point. And I just typically visualize where we are in that range. And you guys would be able to see yourself, like if you marked out, say, a halfway point here, we would be above the halfway point and we'd be more in the premium zone of price action, which is important. Always ask this to yourself. Always ask yourself, number one, are we in a premium or are we in a discount? And number two, is there a fair value gap or are there liquidity points nearby? You keep it nice and simple, right? Keep it nice and simple. The market only targets two things. Again, the first is liquidity at old swing highs and old swing lows. And the second is imbalances in the form of fair value gaps. And all I've done here is I've stopped the chart at 2 o'clock. That is the start of the London Open session. So today I'm going to merge dealing ranges with time. And then I'm going to show you a typical entry model that I use, right? That I use almost every single day to take a trade. And how I'd phrase a narrative, if you like to call it bias, that's great, but narrative of where price might want to go. That's important. So let's have a look now at the narrative. Now looking at this example, let's go to the 15-minute chart, and you can see this is the Asian high and this is the Asian low. These are the extreme points, right? So mind you, any low, any high inside is still like an Asian high or an Asian low, but it's not the extreme point. I use the extreme point as a range. It's really, really helpful, really, really beneficial. So in this example here, you can see that price has swept some of the Asian buy side. So if I zoom in here, you can see, right? This is the extreme, this is the low extreme, and this is one form of the Asian buy side. In this case, we sweep some of the Asian buy side, and what do? We tap into this big sell side imbalance, and we respect this order block. That's all I've mentioned here, right? That's all I've mentioned here. So we tap into the 15-minute CIBI, and we tap onto the 15-minute order block. These three words, in particular, this middle one is the most important. Price can reverse. Does it have to reverse? No. Ruben, is this 100% win rate strategy? No. Is it 90%? Potentially, but depends on the week, depends on the day, depends on how you execute and what you're seeing on that particular day and the market conditions. When you're trading, it's all about probability. So a lot of people get caught up with risk to reward or win rate. It's about probabilities, and this is really important. If price shows signatures that it might want to reverse, or if it's in a key zone where it can reverse, and then you see what you need to see. So I think it's really important to reference the point that price can retrace or reverse. So what I'm looking for personally in my strategy, as simple as it is in two sentences, one sentence, I'm looking at key areas of the market where the price can retrace or reverse, or I'm looking for key areas of the market in certain time windows where the market might do something important. If in these key sections or key time frames, I see the price signatures I need to see for a reversal or a spooling of price, I will take the trade. That's it. Keep it nice and simple. It won't always retrace at a level of premium. It won't always retrace at a level of discount. It won't do that. But this is where you got to look for PDRAs and just consider like stacked confluences. The more confluences you have, the better. And it's up to you how many confluences you need on a given particular day, right? So for me, based on the market conditions, this could change. More than one is better, 2, 3, 4, 5. It depends on what the market will give you. The same thing, guys, for the PDRAs that I'm willing to enter from. So again, we just got to wait now for the PDRAs to support the idea. Going back, just to summarize, right? Nice and simple. This is the Asian range. We're in a premium of that range, so we're looking for sells. Secondly, are we in a key time frame? Yes, 2 o'clock. Beautiful. Third, have we swept liquidity and filled an imbalance? Yes. These are 2 important price signatures. What else have we respected? A bearish order block. Beautiful. Now we just wait for the PDRAs and then we take the trade. Simple. Keep it nice and simple. But no strategy is going to be 100%. Really, really important. So have a look here, guys. Ask yourself, why should the market go where I want it to go? Why should the market go lower? Why should the market go higher? If you can't answer that question, don't take the trade. If I was to answer this question for you guys for this particular trade, why should the market go lower? The market should go lower or can go lower because of the fact that we've returned to a premium of the Asian range. We're in a macro, we're starting the London Open session. We've just swept liquidity, right, on a higher time frame and filled an imbalance. So it's expected or anticipated that the market can now retrace or reprice lower. How much can it reprice? I don't know. But for me as a trader, I'm aiming for 10 to 15 handles, nearby imbalances, nearby liquidity, right? Handles just points, right, on the chart. And that's something really important to consider. I'm not demanding like price to go from here all the way down here. It's not the case. I might demand for price to go from here to here, 10 handles. Is that a 1 to 2? Maybe. Is it sometimes more? Yes. Is it sometimes less? Yes. It just depends on the market conditions you give me, and that's just all it is, right? So really, really important to keep in mind. And we can actually take this a step further and then apply the term dealing ranges to this particular scenario. So let's look at all of this and let's extend further now on the same example, and let's look at dealing ranges. So just to define dealing ranges in my eyes, guys. In my eyes, a dealing range is a price range where the market is trading within. It is a fractal concept. So as such, it's something that we can apply to all time frames. So the 1 minute, the 10 minute, the 15 minute, we can have a big dealing range, a small dealing range, an even smaller one, a medium one, but you got to pick what's relevant to you. And we're going to look at examples based on what we've just seen. So I think it's something really important to keep in mind if you're watching this video. A dealing range, it's a fractal concept. So if you're a scalper, that's the bigger dealing range, right? But it's not that important because you've got to narrow down the dealing range to make it suit your style of trading. And the more important dealing range in this case is either using the Asian high and the Asian low and pulling a fib off that, or as we talked about, grabbing this high and this low and pulling a fib on that, because that's within the Asian range. And again, that's what we've kind of discussed here, right? So we pulled a fib from this swing high to this swing low. A lot of people get confused. They go, well, Ruben, like, you know, why are you taking sells if you're below equilibrium? Because that's a bigger range, and I'm looking now at a smaller range. And on that smaller range, you can see that we're in a level of OTE, right? We're also in OTE of the Asian range, and we're in a key time frame, and we swept liquidity, and we filled an imbalance. These are the things to keep in mind. So you got to keep it nice and simple. Depending on the style of trading that you're doing, this will change how you apply the dealing range. It's really, really important. And lastly, for the people that are keen, I've got some extension concepts about dealing ranges here and how to use the dealing range. If you're still here, comment down below the words dealing range. And I've seen your comments. I know that you guys are still here, and I know there's a few repeat people, and I do appreciate the support. A lot of time goes into this, right? But I like this style, I like this format. And again, all of this is available online, right? So all free. And then if you want to join the free Discord, I'll have the PDFs there and also the videos. You can treat that as your own, ICT mentorship. Now, in this extension topic, we're going to be extending on the concept of dealing ranges. Again, we've got the Asian high, we've got the Asian low. Now, I've put some letters here, right? This green box and this red box, it's the same as what we've seen here. It's this green high and this red low. And remember before, we pulled a Fibonacci on that zone, right? So all we've done here is I've marked out that high and then that low. This is what it looks like on the 1 minute chart. You might say, well, Ruben, like, how do you know to pull a Fibonacci on this high and not this high or not that high? Well, that's the Asian range. So I'm looking inside of the Asian range, number one. But I'm also looking, and again, this is really important, I'm looking at which highs are visible on the 15-minute time frame, because these are the important or the prominent highs. So the 15-minute time frame is like my bellwether chart or my narrative chart. And then the 1-minute chart I use to narrow it down, which we're going to talk about here. So again, we've talked about different levels. This is A, B, and C. So this is the previous dealing range that we pulled. Now, here's the thing. Price then starts to move its way up. It moves its way up. What do? We come into a level of premium. And this is the example we talked about before. We talked about how we came up into premium of both the Asian range and the dealing range. So we're looking for sells. A macro is present, so we're looking for sells, and the macro should spool. Plus, we're in the London Open session, which is great. And realistically, you might go now, well, how low can I take it? Like, if I don't want to go for 10 handles, if I want to just watch price and let it develop, what are some things that I can use in terms of dealing ranges to get an idea of what price should do in this area and how it could react? And it's a really, really good question. So again, this is one dealing range, and we're using that range to go short. Once price starts to move down, then we've got to consider this range that's just been created from point C to point A, right? So we use the initial dealing range, the downwards move, the left side of the curve. We pull a Fibonacci, we come back into premium, we're looking for sells. Macro pricing is just we take the sell. Price starts moving down, now we consider this buy side of the curve. And this buy side of the curve has two ranges that are important to me. The first is the bigger range, and that's from point A to point C. And the second is the smaller range from point A to point B. And again, if you go on a 15-minute chart, point B would be visible and point C would be visible. This little swing low, it doesn't matter when you're doing dealing ranges. It's too small. When you're looking at dealing ranges and you're looking at price ranges, I personally like to use the 15-minute time frame to get the bigger picture of the swing that's already occurred. You might say, well, how do I apply that? Yeah, I understand, but how do I apply that, Ruben? Well, let's assume this, right? Let's assume you're in a short position. You just want to keep holding it or hold a runner. When price gets into equilibrium of A to B, mitigate your risk, because price can always retrace. When price gets into OTE of A to B, mitigate your risk. If there's an imbalance on a higher time frame, say here, in OTE of this range, watch how it reacts in that zone. If it reacts in that zone, in OTE, in a macro, in silver bullet, it could be a sign of reversal, right? So there's all these things to consider, right? And then let's say price came all the way down here. This is really important. Say price came all the way down. We tapped into OTE of this range and we disrespect it. That's fine. We now look at the bigger range from A to C. And if we don't use A to C's OTE to react, then we assume that C is going to get swept. So these are like these little key price niches. A lot of people ask me, like, how do I read the markets? What I'm looking for? That's what I'm looking for. I'm not trying to predict. Like, I'm not going to say to the Discord, or even for myself, I'm not going to say, yep, price is definitely 100% going to come here and then react. What I'll say is that if we do react from here, from an imbalance, during a key time frame, and we have the key price signatures, and we still have a clear drawn liquidity, then maybe we can take a reversal trade. So what you've got to do, and what I do personally, is to mark these zones out. Get good at marking these zones out, both on the left and the right hand side of the curve. Dealing ranges, as you've seen, can be used to phrase the initial trade, and it also can be used to mitigate your trade, to navigate your trade, to see when price might want to retrace or reverse, because again, all this can be used, right? All this can be used. Right, so if we came down here, for example, we reacted during a key time frame, say that's silver bullet now, we had an inversion fair value gap and we formed low resistance buy side, I would take a long. If we come down to OTE and there's no price signatures to go higher, I'm not taking a long. It's as simple as that. If price sweeps this buy side, or sell side I should say, if it sweeps that sell side and now we're in OTE, we're in silver bullet, and we form like a market structure shift, return to a fair value gap, I'm taking a long. As long as I've got a clear drawn liquidity and I see the clear price signatures in that zone on the chart, that's what makes it nice and simple. And it's not about predicting, because again, it doesn't have to react from the OTE zone. So I think this lesson itself is really, really important. It's really, really important. And again, you can continue this price further and further and further and further. So I'm going to finish off with one last concept and then we'll end the video there. If you like this video, again, comment dealing ranges below so I still know that you're here. And if you want access to that PDF or this PDF, let me know in the comments below. Just comment PDF too, and I'll send you the Discord link, the free Discord. The last way, guys, that we can implement, say, a dealing range is you look at this price swing. Like, prices come up, we've come down a little bit. You might be like, okay, I'm entering a short here from this inversion fair value gap, which is exactly what we talked about, previously back in one of these first slides, right? From this inversion. That inversion is exactly what you guys are seeing here, just so you know. It's like right here. And you might have entered short, your stop goes above this height, right? Your stop loss goes there. As price comes down, what if we respect this bullish gap and we retrace up? What am I thinking then? I'm demanding that the market respect OTE of this range from A to this point, only if we start retracing up. If we don't, I let it do its thing. And as we talked about before, we look at this range or this range. So each range has key price points where the market can react from and retrace from. Now, in terms of stop loss placement, let's say price comes down to OTE of this range. I'm definitely going to break even. I've probably already taken a partial, right? So each time price dips into OTE at equilibrium and there's liquidity and an imbalance and it satisfies those two conditions, there is every single chance that the market could retrace or reverse. So that is personally where I mitigate my stops. Let's say I'm going for two contracts, and some people have asked me about stop loss placement. So I'm going for 2 contracts and I've taken one contract off at 10 handles and maybe I'm aiming for 15. Once that first TP is hit, I'm going to break even. And if I don't like how price is reacting, I'll close it. If you're holding a runner, this is where OTE and ranges becomes important, because you can observe how price reacts in those zones. And if you don't like how price reacts, let's assume you're wanting to hold to C. You want to hold all the way to C, right? Price comes down into OTE of A to B, right? And we come down here and we start to show signs of reversal during a macro. I'll trail my stop into profit. There's no point letting price rise into here, come all the way down and then stop you back out. There's no point. And guess what? If it continues down, you've secured money from the market. So this video here is a bit more in depth, right? A bit more of an extension, but this is personally how I use ranges. If you have any questions, let me know. But until next time, guys, I'll talk to you then. Peace.